Yeah, right. So I think I've hit the jackpot with these two partners of mine in the way that we structured it. So the 10th way to de-risk your business is to separate the responsibility between three owners. I have in my business what I call strategic permanent partners, Glenn and Tyler. They're not deal partners. I see a lot of guys out social media going to events and they have a different partner on every deal they do. That's really hard to manage. And so we made the decision we were going to become a full service internal investment firm. The three of us were going to be GPs. We were going to split the responsibility three ways. It's worked out incredibly well. Set up your partnerships the right way and try to partner with the same people on every deal.
This is your daily real estate syndication show. I'm your host, Whitney Sewell, and I have an exciting show for you today. Our guest, Josh Cantwell, is back with us. He was on show 433, which has been on, 1,200 and some days ago, depending on what today's show is. But he's the CEO of Freeland Ventures and a strategic real estate coach. And 40 plus million managed in private money, 3,000 plus apartment units owned, 25,000 to 50 million range in properties purchased. He's an owner operator. He's grown a large portfolio pretty quickly, I would say as well. But man, just a vast array of knowledge and experience in real estate and as an entrepreneur. We dove in today to 9 ways to de-risk your business and investments. I loved these 9 things. I wish we could have spent a whole show individually about each one of these, and we could have, but we highlighted a few of those and dove in a little more detail, which I really enjoyed. I know you are going to learn a lot. If you just did a few of these things, you're going to be so much better prepared. Please listen to every detail. Josh, welcome back to the show. It's been a while. I think you and I were calculating almost like 1,200 plus days, since you were on the show last. I'm looking forward to catching up.
Yeah, it's great to be back. It's you do amazing stuff. I mean, 7 days a week for years. It's amazing. You had a lot of guests. You probably learned a ton. And share amazing stuff. So thanks for inviting me back, man. Absolutely.
Yeah, honored to have you back. Your business has definitely grown a lot since we probably talked last. Ours definitely has that long ago. But looking forward to it. You are doing some pretty amazing stuff. And as the listeners just heard, they know a little bit about you, but give them a little bit more about who Josh is, your business focus right now. And let's dive in. I just want the listeners to know, hey, Josh is going to highlight today 9 ways to de-risk your business or investments. And I'm looking forward to that conversation. I know the listeners are going to learn a lot. So, but before we do, man, in case they didn't hear, and just so they know, show number 433 was when Josh was on before. If they didn't hear you then, tell us a little bit about who Josh is and let's dive in.
Yeah, for sure. First of all, I'm a family man, father of 3. Follower of Christ. I am a volleyball coach. I coach club volleyball. And I'm fortunate to have finally seen the light after 15 or 18 years as an investor. About 6-7 years ago, really started focusing on commercial multifamily. We did thousands of residential deals and never really got free with that. We were always still transactional, made big incomes, many years, in the millions of dollars range, but never felt free. Always felt like I had to keep working. And today, I probably work about 25 to 30 hours a week. I secret shop our buildings all the time. I show up sight unseen, which is one of the ways to de-risk your business. We'll talk about that. And just focused on what I would consider managed growth. I think everybody has a different pace at which they like to grow. Some people like to grow really fast and buy all kinds of stuff and just go crazy, and they leave this chaos in their wake. We've definitely had periods of like that momentum like that. But I also think that times like these, you want to be a really smart operator and you want to grow at a pace that's convenient and comfortable for you or for me. And so I think that's, again, one of the ways to de-risk your business is to grow at your pace, not what the pace is you see of everybody else on social media. So we'll talk about that too. And so today I'm really enjoying life because I feel like I have a tremendous amount of balance. My kids are going into a bid tournament this weekend for volleyball, and we have a chance to get national bids. Both my girls are really good and really competitive. So I'm going to shut it down on Thursday and go to this bid tournament, and I'll be coaching my face off, man, with these young girls, trying to help them earn a trip to Minneapolis. So that's a little bit about me, man. A little bit of personal stuff and some business.
Yeah, that's awesome. I appreciate just sharing some real things about you outside of business, as well as a couple business things that, or at least one, I wanted to ask you a little bit about before we jump into the 9 ways to de-risk. But you mentioned working 25 to 30 hours a week. I know everybody's saying, well, how does he do that? He's got all this stuff going on, all this, buying all this real estate, managing all these team members. We're talking about growing, right? Or, you talked about at your pace, but man, how do you get away with only 25 or 30 hours a week?
Yeah, it's cliche, but it comes down to the team, right? So me and my 2 partners, Glenn and Tyler, I'm the majority owner and CEO, but I have 2 partners, and we've split the business up into 3 swim lanes. My swim lane is acquisitions, acquisitions, investor management, investor recruiting, pretty much the whole capital stack, underwriting, a lot of the things at the front end. And then I want to be out of the day to day so I can operate outside my business and above my business. So then I can see everything that's going on and poke holes in things and, think through things. So that's my swim lane. I've got a couple employees and staff that work under me. My partner, Glenn, is a partner and also handles our capex division. So our VP of construction sits under Glenn. All of our unit turns, commons, dog parks, anything that has to do with capex falls under Glenn. And then Tyler is another partner of mine, again, minority partner, but he handles asset management. And asset management means he oversees all the property managers. So he deals with the property managers who then deal with obviously everything from maintenance techs to leasing, evictions, and so on and so forth. And so I've really focused in on what I feel is the 2 most important things, which is control the money. And then you have to be the one that rubber stamps the deal if you're going to buy it. You have to understand the capital stack, understand the risks. And so those 2 things, I think, is where you can control the entire business by controlling the funding. You can control the entire business by controlling the flow of money. You control the entire business by controlling which deals you buy and which investors you bring into deals. So I've taken that to be my my mandate, if you will, as a CEO. That's my mandate, to do those 2 things really, really well. And then allows me to go secret shop everything else. So that if I see something that's wrong, which I just did this morning, I just went and secret shopped one of our buildings this morning, I can then feed that back to Glenn, feed that back to Tyler, and then they will take care of the execution of those kind of things. That's allowed me a lot of personal freedom, a lot of income, but a lot of free time as well. Now, if we were in major acquisition mode, Whitney, right now, we're definitely looking at a lot of buildings, but acquisitions have slowed down. So that's part of it too, right? Let's be honest. Like, acquisitions are a little slower, which has given me a little bit more time for now. If that picks back up in Q3, Q4, then I'm going to be back to working pretty heavy hours.
Yeah, no, I just know that caught people's attention too. And it's like, well, we all dream of working 25 hours a week, right? And then playing volleyball the rest of the time, or whatever that may be, or coaching, but no, that's great. It's really a team, right? It always goes back to the people, right, surrounding yourself. But no, that's great. Well, let's jump in, because I want us to have time to talk about these 9 ways to de-risk your business or investments. I feel like it's perfect. It's always perfect time to talk about that, right? De-risk, but now as much as ever. So let's jump into some of those. I mean, 9 ways. But let's begin. Let's talk.
Look, like if you see some of the stuff that's coming out, there was an investor in Houston that just gave back 3,200 units to the banks. There was another investor that just, Arbor just took back, a major portfolio. And so you see some operators and some sponsors that are starting to lose their buildings. And that's obviously rule number 1 is not, don't ever lose the asset, because your limited partners basically get wiped out. And so I think it's very important, as we look at this recession, we look at some financial distress, there's definitely upside and opportunity, but we have to de-risk the things that we're doing. And when things are really good for everybody, there's a lot of cowboys that make crazy decisions and they don't feel like there is any risk. And so now you realize that there was true risk in the market over the last couple of years. It just didn't come to fruition until now. And so there's 9 ways to de-risk your business. So let me go through these real quick, and then we'll dig into a couple. So number 1 is always invest for the long term and get long-term fixed rate, cash flowing financing. And I'll explain that. There's really three different types, but I'll explain that. That's number one. Number two, always fast forward your capex and push it as hard as you can in the first 12 to 18 months. I hate doing capex organically. Number three, always secret shop your buildings and show up sight unseen. Number four, review your financials in detail every month without exception with your property manager and your CFO, and with the CFO of the property manager. Okay, because the regionals, they don't sometimes even understand your financials. The property managers don't understand the financials. So we force the CFO of our property managers to sit with our CFO and then me and Glenn and Tyler. So review the financials. Number five, commit to sharing everything with your limited partners. This is a big one, and I'll explain this in a minute. Number six, overraise capital and make sure you have at least 6 months worth of operating capital in your operating account. And I'm not talking about stealing from your capex account to cover operations. Okay, don't do that. They're separate. Okay, number seven, underwrite deals at 70 to 75% occupancy and know if your deal's going to cash flow or if it's going to bleed and how much bleed it's going to have. Because right now, a lot of deals are bleeding. Number eight, use the same vendors over and over and over and over and over again. We're talking about contractors and property managers. We'll talk about that. Number nine, buy in 1 or 2 submarkets and stay close to home. Do not diversify into 8, 10, 12 submarkets and then think you're going to be able to understand all those submarkets, right? I would rather own 500 to 1,000 units in 1 or 2 submarkets than own a 200 unit here, a 50 unit there, a 100 unit here, a 250 unit there. Don't do that. Then there's a bonus way to de-risk your business, which I'll talk about. I've already kind of talked about it already. I'll talk about that a little bit more at the end. But that would be number 10. So those are the 9, Whitney, just ripping through them. I mean, if there's 1 or 2 or 3 that you really want to peel back the onion on that you think would be best for your audience, why don't you pick and choose where you want?
There's a number of these that we should talk about. I feel like, man, this is a great list. I really like these. I mean, always investing for the long term. I feel like, man, that's hitting at a lot of people right now, right? I mean, it's unfortunate, right? For so many, they didn't get that long-term financing like you're talking about, and they're going to feel it this year, and they are, or they didn't plan, for that, which most didn't. But maybe hit that for just a minute. Let's move on to a few other things. But planning for the long term. Anything? You said cash flowing financing. Is that what I heard?
Yeah. So what I mean is by that is, look, there's really 3 types of long-term fixed rate financing. There's seller financing, right? That can truly be long-term, 5 to 15-year financing. It's flexible. You can negotiate almost any term that you want. Number 2, there's bank financing. Banks is usually you can negotiate 5, 7, 9-year terms. The trade-off, though, typically is there's a personal guarantee. And then number 3 would be agency debt, Fannie, Freddie, HUD, et cetera, et cetera. Now, what many people did, as you would know, Whitney, is they went with floating rate bridge financing over the last couple of years. And they said, oh, no, we're not going to do any bank financing because everybody hates recourse. Okay. Maybe one of the best decisions we've ever made was to buy properties and actually use bank financing, but very low leverage, 65 to 70% or less. Use bank financing and fix that debt, whether it's through a swap, whether it's through, it goes on the bank's balance sheet, fix the financing for 5 to 7 years. Because again, rule number 1 is don't lose the asset, right? So the worst thing you can do is sell or refi at the wrong time. Well, obviously Q4 of last year was the absolute worst time. Transaction volume dropped by 85%. Nobody was transacting. So if you had to refi or sell, you were screwed because nobody was transacting in Q4 of last year. Even Q1 of this year was pretty slow. So those 3 types of financing versus, hey, I'm going to get the highest leverage I can get with the most proceeds I can get, and I want to go non-recourse with bridge or floater, and then maybe get a cap, a rate cap, that type of thing, and then go with an extension. Well, as we know now, a lot of those rates doubled Mortgage payments doubled and tripled. And now they're escrowing for future rate caps, and these cash flows are going negative, right? And so thank God we didn't do that. We, in some cases, went with bank financing and put up a personal guarantee because we wanted to invest for the long term. And I did not look at 65, 70% leverage as very risky. Look, Whitney, I'll give you an example. We bought a building last year, maybe 2-3 years ago, for $16.3 million. The bank advanced at closing $12.25 million. Okay. Got investors, limited partners to bring in $4 million. And then the bank also gave us another $2.5 million in capex through a draw. So how much risk is there in that personal guarantee? That value of that building is not going from 16.3 million below 12.25. It's not going there. And especially if we execute our capex plan, the value of that building is going to go up and up and up. Now, when I bought that building, it was making about $165,000 a month of gross cash flow. Today, it's making $225 a month of gross cash flow, right? So the value of the building today is worth at least $22 million. If I got an appraisal, it would appraise at $22 million. I bought it for 16. My debt on that thing, I've taken a couple draws. I've done $2 million of draws against the loan. We owe 14.25. It's worth 23. So what was the risk in that personal guarantee? Almost zero. So in that scenario, you're much better off sponsoring the loan, personal guarantee. I'm okay with that because the risk to me was so low. I actually viewed the fixed rate or the floating rate bridge debt to be more risky than the personal guarantee. And a lot of guys went with the opposite.
Yeah, your loan value is so low. Yeah, I agree. I love that scenario. I appreciate the example. You mentioned the capex a little bit. I wanted to just spend a minute or two. Always fast forward capex, like you talked about, pushes hard in the first 12 to 18 months. Elaborate on why that's so crucially important and de-risks the deal.
Yeah, look, like if you want to force value and true value add, value appreciation, you're going to have to underwrite for some vacancy. And we've had deals drop when we bought them at 98% occupied that dropped down to 70% occupied on purpose. So we could really hammer out the capex. Then we would turn a unit in 2 weeks or 3 weeks, like a full turn. We would lease it out and get a $400 to $500 rent bump. I would rather do that and force the value quickly. It also de-risks my loan because the value is now higher. I would rather take and underwrite for some of that vacancy and maybe even a little bit of a cash bleed to knock the capex out early. Also, the other thing it does, it allows you to then settle the building down within 12 to 24 months. And so now all that contractor dust and all the moving parts are gone instead of having contractors working on your building for 5 years. That's going to hurt your leasing. I would rather hurt my leasing for 12 to 18 months and then really have a quiet building that's stabilized and then be able to lease out and get back to full occupancy. So we've done this. Look, I've done 19 of these syndications. I've done it the slow way. I've done it the fast way. It actually de-risks your business by doing it quicker.
Yeah. No, I like that as well. And I want us to have time to get to a couple more of these at least. But you mentioned commit to sharing everything with your limited partners. I completely agree. But tell me about your process to do that and how you're sharing everything and how your team is simplified this process, right? Of updating investors on everything.
Yeah. So first of all, I know a lot of operators that do not share their P&Ls and balance sheets. Let's start with that. Share your P&L and balance sheet at least quarterly. We do our P&Ls on a cash basis, not accrual, because I look at accrual financing as witchcraft. Accrual is great. That's how a lot of people do it. Cash is cash. If we have cash, we put it on the P&L. So that's the one thing. I think accrual accounting is I call it witchcraft. It's not witchcraft. It's generally accepted, but I think it's witchcraft because you can really kind of finagle the numbers a little bit with accrual. But those are the two big ones. Share those at least quarterly. Number two, all of our capital improvements all goes into a PowerPoint, and the exact documents and spreadsheets that we use to actually manage the capex, we do not edit those. We share them as is with limited partners. The exact vendors we paid, how much did we pay them, how much per unit, all of that stuff gets shared once a quarter. Video update. I can't believe how many operators don't get on video once a quarter and talk to their investors about what's going on, the good, the bad, the ugly. Tell them everything that's happened, right? I'm also, limited partners, a lot of them don't know how to read a P&L. So actually share the actual P&L for that quarter on your screen share and walk them through it. How much money did you spend on insurance? Is insurance costs going up? How much did you spend on utilities? Are you able to save any money on utilities? What's your plan for the next quarter? I love managing the business on a quarterly basis. So those are 4 must-dos. Now, the other thing that we do is we always share our cash position every month. Now, we share it quarterly, but we'll say, this is how much cash we had on January 1st. This is how much cash we had on February 1st, March 1st, and so on. This is how much capex we spent January 1, February 1, March 1, and so on. This is how much the bank owes us in a draw, January 1, February 1. So they see it on a monthly basis, even though we're reporting it quarterly. So it gives them some insight onto cash movement, right? So those are 4, 5, 6 of the things that we do every quarter without question. And sometimes I'm like, crap, man, we were kind of slow this quarter. I don't know if I really want to get on the phone and talk about this, but I do it anyway. Because it also, what it does is that as I talk through it for limited partners, I know I'm reiterating to myself what the major points are that we need to continue to focus on and go back to the business and back to my partners and say, you know, we've really got to focus on this, right? Because if you force yourself to be honest and put it out to the world, you're going to be a better operator. You're just going to be a better operator.
These are a great list of things right there. This is good. There's a couple of things there you mentioned, like a lot of LPs don't know how to read a P&L, and so do a video and talk about it. I think it seems so basic, but most don't do that, right? And bring it up on the screen and talk through that, educate your LPs. And I think you're gonna retain more LPs by doing just those things, right? And thinking like that, and not assuming they understand all of this. Let's see. Oh, yeah. And the cash position every month. I appreciate the list there of things that you mentioned. And you talked about, and maybe back up just a little bit, you mentioned you all do this in a presentation, maybe internally, and then you all just use that for your investors as well. Maybe talk through that process just briefly.
Yeah. So here's our process, right? So our property managers are due to produce for my CFO our P&Ls and balance sheets by the 20th of the following of the month. So if we close out January, it's due by February 20th. If we close out February, it's due March 20th, et cetera. At the same time, my capex team has to close out their month and report their capex numbers also by the 20th for the previous month. Then my CFO has 1 week to look at all those and go back CFO to CFO and poke holes in the numbers and make sure they're meeting budgets or make sure that they're in the right categories. If there's an outlier, for him to get an explanation of why there's an outlier. Maybe we had a large water bill some month, or maybe we had a large, unit turns, or maybe we had, like back at Christmas, we had a bunch of ice and we had some ice and snow damage. So Roberto, my CFO, then goes through that. Now, at the end of the quarter, what's happened, if you close out, let's say Q1 at the end of March, that's all due by April 20th. Then by April 27th, Roberto's gone back and forth. Now Roberto's got to present that to me, Glenn, and Tyler on the 27th. And then I'm recording for my investors by the 30th, and we're paying out that quarterly preferred return by the end of that month. So everybody on my team knows that's the system. Those are the deadlines. That's what we got to meet. And they know that I'm going to be really, really upset if I can't record that video for investors and pay out the preferred return by the end of April for Q1. Okay, so that's our system. It's been that way for years. And now everyone's getting pissed off if we don't have the financials from the property manager by the 20th, and Roberto's not doing this thing by the 27th, and we have our meeting on the 27th, 28th, and I'm recording by the 30th. If that's not happening, our director of investor relations is she's having heartburn over that. She's pushing us all. I got to get this out by the 30th. So it comes down to setting these deadlines that everybody has to meet. That's worked really well for us.
To the CFO versus the asset manager there doing that, with the other CFO reviewing the financials, those things.
Mm-hmm. Yeah, Roberto, look, he takes a lot of pride in the fact that we're hitting budget. We put together budgets. We spend a lot of time at the beginning of every year putting together budgets for that year. The property managers present the budgets, and then we go negotiate those budgets with the property managers. We push the property managers hard to make sure that those budgets are tight. They're not going to have a lot of fluff in there, a lot of fat. And then Roberto's like, we're gonna manage the property managers hardcore. So it's really Tyler, who's my partner and asset manager, and Roberto, as CFO, kind of double teaming the property managers together to make sure that they're hitting budget. And if they're out of budget, why? Got to have a good explanation.
And are you all third-party management or in-house?
So we hung our hat on capex, and we own the construction company that's doing all of our improvements. So we didn't want to do the third-party management and capex at the same time. So we outsource and do third-party for property management.
Okay, no, it's interesting.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.